Good evening.
Well, good evening, everybody, and thank you once again for joining us with another rendition of a medical update or webinar where we would like to give you some information on what's happening on the ground at the moment, specifically on some new opportunities, what's the ins and what's the outs on the healthcare sector. And thank you very much for joining us. I think for the moment, we're just going to wait 5 to 7 minutes to see who can else hop on. I know sometimes people run a little bit late. In the interim, can you please just have a read through on our disclaimer that's currently showing, and we will catch up with you in the next 5 minutes.
5 minutes is a bit long. Sorry about that, guys. The screen was paused for a moment. Yes, JPS, thanks, and yeah, welcome. I'm noticing that it's not changed yet. I apologize. There we go. It should be to the screen now.
Yeah, let's let them familiarize themselves just for a couple of seconds while we see some of the more people hopping on. The numbers are jumping now, so give it 2 more minutes and then we can start with proceedings for the evening.
Yes. Okay, I think let's do this, JP. I'm ready. Let's change the slide. Let's yeah, I think yeah, we're going to do USA medical opportunities tonight, and yeah, JP, let's get the show on the road.
Yeah, thank you very much, Willie. I would just actually, before we start, like to introduce you my esteemed colleague, Willie Ulof. So he is our due diligence and our risk assessment manager. He's the guy actually punching all the numbers, hitting the calculators, checking all the I's and dotting all the T's. And at the end of the day, just very privileged to share another webinar with you tonight. What we have on the agenda tonight, we're going to have a quick business overview for those who are logging on for the first time. Who is Wealth Migrate? Where do we come from? What have we been involved with? And then predominantly tonight, we're going to focus on the medical opportunities. So just to jump in straight ahead, Wealth Migrate is an online real estate marketplace, and we've actually been involved in doing a lot of the opportunities, more specifically in the healthcare sector and multifamily. Now, if you look at the business numbers at the moment, we've concluded more than 870 transactions to date over the last 4 years. In the countries, we've actually had investors looking into our platform from as much as 89 countries. We've got actual investors who've moved transactions from 18 countries, and that is also jumping very rapidly over the last quarter. Our average transaction size is actually lowered from the last 2 quarters, from about $78,000 to $64,000.
Yeah, exactly, and that's because we've launched from last year $1,000.
That's correct. So ultimately, the goal is to get that average transaction size down to as little as about $10,000. Now, what you can also notice is that the team has also grown, and we are well over 50 staff at the moment. And investors over the last 4 years since we've launched our commercial platform, we have actually invested equity amount of more than $55 million. Up until recently, with returns and dividends paid out, we've actually almost reached $2.5 million, which is quite a significant feat for a company with us. And I think everybody is really excited to see where the company is going with the numbers at the moment. Just to keep you abreast of what's happening, where we're going to be, we're hosting some really interesting workshops over the next week or so. We will actually starting tomorrow, the 25th of May in Midrand. We're going to hold the 9 to 12 p.m. a real estate investors workshop where we really unpack everything and how we approach investments, and we're going to try and give you tangible takeaways from that session. So I think it's definitely not to be missed. And at a later stage, we are also very privileged once again to have Willem van der Post from Deloitte to share some of his insights. We've actually, on our last roadshow, had a lot of clients asking, can we have more time with Willem for him to go into detail? And we've arranged exactly for that. And then we've also got a very exciting wealth partner dinner for those who have invested within the company tonight. To date, we also try to get them under the same room and also let them socialize. We have the same routine going again on the 30th of May in Durban, and then once again on the 1st of June, we will be visiting Cape Town as well. If you want further information, you are welcome to go on to events.wealthmigrate.com, where you can find everything. You can also see there we will be hosting a wealth weekend, which will be hosted in Gauteng. More details will follow soon, but it's closer to the end of June. You'll see that the dates are the 23rd to the 26th, and this is also once again where all the wealth partners come together, the board members come together, and we really strategize and share everything to detail what's been happening with the company. We're also hosting a real estate summit, which is going to explore a little bit more on when technology has met real estate and what the impact is going forward, and that's going to happen over a 2-day period from the 30th of June to the 1st of July, hosted with Willem van der Post and our very own president, Dr. Dolf de Roo. So it's going to be a big privilege to have him with us again. Just before we go on to the proceedings for tonight, I think it's very important to still highlight there's still the competition running currently for our opportunity in Cape Town. You can invest like a millionaire, and if you refer people to go onto the platform and they actually invest, you get an entry for each investor going to win an apartment of about 2.5 million rand. So that's really still exciting, and it's still running, so you can definitely check that out. Over to you, Willie, just to kick us off for tonight.
Yes, no, thank you, JP. I just want to emphasize on the event side, myself is going to be there. I'll be talking about a whole GIGS process, how it works, why we're using it, what due diligence do we do, and yeah, so I'm looking forward. If you have got any questions relating to any current deals that we've got on under management, or any deals coming soon and you want to speak to me about it, you're more than welcome to join us, book that seat like JP said. And yeah, so tonight it's again about medical real estate. It's for those that have not been able to join us earlier, we like medical real estate. The reason for it is it's an asset class that is recession resistant. You know, we have to take into consideration because the fact is doctors is generally good tenants. They've got long-term leases in place just because of the fact that the nature of their business. You know, it's patient orientated. They get to know the patients very well. If I consider my house doctor, yeah, my mother was a patient of him, and so he caught me, and I still go there when I go back to town. You know, so because he's still where he was 10 years ago. And some of the more specialized surgical guys, they've got high tenant installation costs because of the type of equipment that they use. It's very finicky. You can't just move it around. So you want to make sure you stay in that position. So it's highly unlikely that they will move unless they retire. So what it in natural entails is that you have long-term market fundamentals that remains favorable, you know, and that's what our research has shown. We look through a number of different market resources like CBRE, JLL, Marcus and Millman, and they all say the same thing. You know, the tenant demand is fueled by the demographic trends rather than economic growth. So people are, the population are growing, and that's one of our fundamentals. We don't want to head into a country where there's not a growth, either by migrating to a particular town or by physically just growing. So within the borders of the US office market, we still see that the medical sector real estate is still a niche, And the long-term benefiting demographic trends, like we said, is increased utilization and spillover from ongoing expansion in the life sciences industry. So what we've seen now, and that's one of the things which I'm pretty sure Willem van der Post is actually going to touch on. You know, there's so much advances in on the health space, on the technology side of things. You know, it causes people to live longer. Now we have to also say is those that can afford it. I've watched some. Looked through some statistics in Africa, specifically Zambia, just during the course of the week, and the life expectancy there is 54, and it's mainly because of that technology not really reaching out there, and it's still a bit expensive for some countries in doing it. But we have chosen USA just because of that kind of thing, and that underpins your demand. What we also see is that well positioned to capture more foreign dollars as buyers are seeking out higher yield but still relative safe investment opportunities. It's safe just because of these fundamentals that I've just explained to. So if we look into the US market, you know, and that's why it's such a great place to go to. There's 325 million people that lives there, you know, so, and it's projected that by 2050 this number is going to be 23% higher. And what you're seeing is from the graph on the right side there is that the over 65 population is basically the guys that's making use of these services. So 1 out of 5 individuals will actually still make use of healthcare, and specifically in the next couple of years, which means is that you're still going to see these fundamentals being underpinned by it. So what we also have seen is that there's a trend towards outpatient care enjoying uninterrupted growth. So it means is that the guys are moving a bit away from the space like we've seen with Medical 7 that is almost at the end now. We've pre-funded it, and it's almost closed. And it's in Dallas. It's a bit off from the hospital side of things, so it's a primary care unit which basically stimulates the hospital's patient, I want to say growth, but patients going into using the hospitals. So that's why we're seeing, and it makes it also that the market is moving closer to where the patient base is, you know. So for instance with Medical 7, it's in the center of Irving, and so it's well placed for the patients to reach those facilities, and that's the type of facility that we also like to invest in. So what we're seeing in the millennial generation is that in size it is already past the baby boomers. So that's also driving a major shift in care delivery model. So that's the kind of things that we also have to take in consideration. You know, you get some because of technology, you can reach people also a bit better. Millennials are making a bit more use of technology, and that's the kind of things that we need to take into consideration as well. But we don't see that as a problem at this stage, because of the demand is still growing. Where you'll see the technology really reaching out is in the spaces like Africa, where it's vast spaces that is unreached, where technology really can make a difference. So the other point that we just want to need to touch on is the whole Affordable Care Act and the Obamacare. We all know Trump he's came in with a bang. In his first 100 days, he's got now a bit of new issues. So, which to one extent is for my perspective not that great, and a bit of a concern for me, because if we see now with all the political uncertainties, some of these matters is not going to be attended to, and there's a bit of a focus that's been lost, specifically on the tax cut size, but. And that's the thing that why I'm pointing out the Affordable Care Act is that he was successful, I think, in the third attempt, JP, in getting it repealed through the House. So we are carefully watching this space as to what will happen and what will eventually end up going to the Senate. There's been a lot said as to what will change. I mean, initially there was a lot of changes that Trump wanted to implement it, but it's been dialed down. You know, as time goes on, it's going to be interesting to see what is actually going to end up staying in the Affordable Act. So what we know is now previously, initially when he went out on the election trail, he was saying he's going to repeal it in its entirety. So my concerns are being dampened. Just for those that like the numbers game, from this 325 million people, 86% of them already has some sort of healthcare insurance types. So it means that the Affordable Act is actually, from the latest numbers, is around between 11 and 18 million people that they expect are making use of this service, and that's actually the ones that's apart from the 86 that's already got some sort of medical care. So will it affect us? I don't believe so at this stage, but we are monitoring it carefully, and you'll be the first to know once we also have seen some more action from that.
Yeah, just to add to what Billy is saying, I think it's important to note that whatever happens with Obamacare, specifically the asset classes we look in and getting invested in is not typically catering to the demographic that is actually subject or actually dependent on the Obamacare. So whether that gets repealed and how it gets enrolled, you're not as directly affected as a lot of the clients out there are thinking. So, I mean, that's also a little bit of a sense of comfort that we are catering for people who can already afford these type of cares. And I just thought it's important to highlight that.
Yeah, so now that brings us to what we call ASS, ASC Medical Aid. It stands for Austin Street Capital Medical Aid. Yeah, I think this is our first building with Rick Benson from the Hedge Development Group. Austin Street Capital is their management company. So what they actually do is they develop brand new buildings. So this building is myself and Phil and Henny has seen this building now, and I think Scott was there also last year. We were in talks. We started talks end of last year in getting this into the stable, but the timing just went right at that stage. So we're quite excited and happy to finally bring a new partner to the stable, which has got tremendous history and experience specifically in medical building developments. So we envision the pipeline that they've got. We've already starting the talks with a new building that they also have finished, I think, end of last year. So they are in the stabilizing process of it. So what we're getting here is a stabilized, brand spanking new building. Now, because this one has been completed in 2015. It means that it's already 2 years old now, so all the minor glitches have been sorted out, and as you can see, it's been launching soon. It's on our coming soon page. So if you like what we are just talking through tonight, go on the website, register, and show your interest. We are hoping to launch it within the next week, and we'll register, and you'll get the first pointers on it. So what I want to touch on just briefly is this building is also in Texas, USA. We've spoken in quite detailed in some of our earlier webinars. I think the previous webinar that myself and Michiel did, I think is in April.
Yeah.
We touched in Texas. So I'm not going to spend a lot of time on it. The highlights for me is the fact that medical malpractice are capped. It's an at-will state, which means that the landlord has got more rights than a bad tenant. And I think for me that is the biggest thing, and what I specifically want to highlight again is the Texaplex, which is where 80% of the population of Texas lives in. That's Dallas, Fort Worth, San Antonio, Houston, and Austin. And what excites me, JP, about this transaction is it is in Austin. We can now say that we've got a building that we've brought to the investors in Houston, a multifamily, which is Cypress Ridge, which we closed off I think a week ago. Then we've got a building in Dallas, Texas, Irving, which is the Medical 7, which is almost closed. And we've got Waterridge, which is another multifamily, also in Irving, quite close to Medical 7. So we've now branched out to Austin, which I must admit, JP, I love Austin. If you would want to send me there, I'll gladly move there. It's a lively city. It's the musical capital, and it's Austin is the capital of Texas as well. So we've seen that 70% of the money that is spent on the budget side, which is not that common, as you know. We in South Africa struggle with the police and the emergency services, and that's also something that's great for the medical industry, because that's part of the emergency services. So that also assists us, and why we would like to be there. As you can see, it's sort of on the outskirts of Austin. It's it still falls within the metro of Austin, and Austin is developing in that direction. It's a bit more upscale area, and what we've found is that Austin has been growing so substantially. It's been still rated as one of the fastest growing cities in the States. And that growth has sort of caused some of the locals to move out a bit out of the city, and that's why Manor has got a university there. And they've got a Walmart. It's almost a city on its own. And the Shadow Glen Medical Towers is the only medical facility in that area. It's got surgical facilities. And there's a primary doctor that's also going in there, which means that maybe I should explain it this way: is you need a primary healthcare facilitator, which is your normal GP, to send the patient to a surgeon. If you had some previous medical history, then you'll know it's not, you cannot just walk into the specialist room. He expects you to first make a visit to the GP, because he's quite busy. Yeah, so and that's what we see. They've got they've got a pharmacy in there. There's a wound care, and then there's additional primary GPs that actually just moved in across the street. So we're really seeing and is excited about Austin. It's not relying just on one sector. So it's got technology, it's got pharmaceuticals, it's got biotech industry, and it's still a lower cost of living that you'll find in the US. And like I said, it's a beautiful city as well. And one of the important things for us when we consider our GEETS system, our GEETS rating system, is the location, our sector preference. So medical is one of our sector preferences. The location, which is growing, and specifically the population growth. So as I mentioned earlier, is that it has been a fast growing city, and has been topping the charts, if you can call it that way. And in the past 3 years, it's been growing more than 3.15%. So Austin is growing in the right direction. And yeah, so let's look at the numbers. You'll see it now on the screen. So the building is 34,602 square feet. And the deal value is 11,065,000. With equity portion that we're looking to raise of 4 million. The sponsor, as usual, is also contributing around 3% of that 4 million. So he's also got skin in the game. So you don't need to worry that he's just pawning off the building. He's also part of the project. He's also standing surety for this building. So that's great, and he's also assisting us with the management side of things. As with our other buildings, we've got a bad boy clause. So if he doesn't perform and we're not happy with the way he's managing the building for us, we can just kick him out and appoint someone new. So the internal rate of return before tax is 15.3%. That is for the investor. The project, just so that you know, before the hurdle rates comes into play, is 23%. So we are anticipating that there's going to be about an 8.4% quarterly distribution that's going to be able to pay out. So what is great about this building is that it is 95% tenanted. The main tenant has taken up about 75%, and the contract is still eight years. And like I said, I mean the chances of that 8 years not being well, extended is fairly slim. So what I just wanted to say is the main tenant is United Health Group. They are currently the biggest health services company in the US. So they've actually recently brought over the tenant that is currently there, which is REITS. So you'll see on some of the pictures that I'll show just now is that there's the name REITS. They've actually been in the last since we've started this process. I think in the last couple of months they've taken over REITS. So the great part of this investment, which I like, is the fact that you can invest for as little as $1,000. The key rating is 9.4. Like I said, what we've considered is the location. It's the sector that we like. The financials looks great. In the track record of the sponsor. The sponsor, I think I've already mentioned, he's got 25 years of experience in this medical development market. He's raised about $110 million for his projects, which is roughly, I think in the last couple of years, over 10 buildings that he's produced over 5 states. So if I carry on, this is how it looks from on top. As you can see, there's ample parking space. It's next to the main road that leads through Manor, so it's well placed. It's visible, and I think if my mind serves me correctly, it's just opposite the Walmart. So you can do your shopping whilst you wait for your family members. As you can see, there's a residential units just a block away. It's the building is called Shadow Glen. As you can see, it's quite a. I think I like the building. It's quite pretty. It's got some stone features. It's not your stick building, normal stick buildings that you will see. It's got it's quite a good looking building. It's got very.
Yeah, it's similar to what we will get here in South Africa as a typical A-class property. I believe you yourself actually have been to this property. Was it early in February this year? Or?
No, it was end of last year, October. I've been at the property, so I've actually been there twice.
What was your initial impression on walking in there? Just comparing it to your typical A-class properties here in South Africa.
No, I think it's the standard and the quality of the building and the way they build it, it's top class, and that's why we like it. And what I said is we're looking and started negotiations with his next building, and I've actually been able to see how they do it. You know, they were still busy doing the inside of the building, so I can see the attention to detail. It is quite well thought of and well planned out. So as you can see there on the list, you've got a REITS there, which is taking up most of the space. And as you can see, they've got diagnostic imaging. They've got the wound care, and it's one of the few in Austin. So it's a destination stop as well. And they've got urgent care. So urgent care is basically what we call emergency rooms here. So which means they've got some traffic going into this building. So just a graph as to what the leases look like. As you can see, there's about a 5% vacancy in the building. And then the 2017, that is actually an error. I note only now, but that 6,940 is actually a 3-year master lease, which we've contracted with the seller. So they will be for the next 3 years be paying the rent for a vacant space. What happened is that a tenant actually bought what do you call it? He actually
bought the business.
No. He intended in going into the building when the building was being built, but he ended up because he's been in one of the other buildings that they also own, and just before they started finishing just before they finished the building, they actually he said to him he cannot afford it. And at that stage, we started the negotiations process, and just to keep with what is attended initially, he still offered us the master lease, which will ensure that we've got 3 years market-related rent coming in for that space. And that's why the year is a bit is not entirely correct. And but you can rest assured it's 3 years and it's contract date in that way. So in the 3 years, if it happens that he has been indicating that he has got some guys looking at that space, then the lease will just elapse. But at the least, we've got insurance that we've got 95% covered. All right. So what is the risks? I think that's where I come in, and I look into these things. One of the main things for me is the tenant risk, failure to honor the lease obligations. So what do we do to mitigate that? We do proper credit checks. I mean, what we know now, I mean, is United Healthcare has got 75% of this building, so they're well established, so they've got a good reputation, they've got the balance sheet. So that's what we're looking for, and they're willing to assign long-term leases. So the debt covered ratio allows for 25% of the revenue that can drop. So what the debt cover ratio, what we're saying by that is that our net operating income needs to be more than what the interest or the debt payment will. So if we consider that, it means that if we pay $100 to the lender, our net operating income needs to be $200. So that's what we've established, and we geared the property to that extent, so that we can get to a 2%. 2 times net operating income. So other risk is the interest rate risks. I think that is one of the things that we've. Sorry, I just want to make sure you guys can hear me. All right, sorry about that, guys. I think we just had a bit of a bump in the signal. I hope you can hear me again. As I was saying, is that the other risk that we want to mitigate is the interest rate risk. It's been clearly set out by the Fed to forming the markets that they are planning on raising the rates by 3 times this year. They've already raised it once earlier this year, but the indications are that they actually could not or will not. All depending now with the whole Trump turmoil. But just to cover ourselves, we're looking to fix this interest rate for 5 years. I'm sure that the whole economical cycle where we are in at the moment is that we're going to see a bit of interest rates going up in the near future, and we just want to mitigate that risk. Then the other important thing is the economic conditions, which is the valuation risk. That's why I made mention to that we are lowering the gearing on this particular building. We are only financing 65% of it, and that ensures that we have got an average of over 2 times the net operating income. And we went to the same lender as whom has financed our other buildings, which is Capital One. They are a strongly capitalized lender, so they're not going to, if there's a hiccup with my expectation of the stock market that needs to pull back, if that occurs, then they're not going to get a capital call. And that's essentially what we want to ensure and cover our investors against, is that capital call. And that's what we've seen, when was it, in 2008. Essentially what happened is that the bank, the lender, didn't have enough capital on his books, which meant that he downgraded and devalued, is it devalued? Yeah, devalued the assets, which meant that the investor needed to either pay in some money because at that stage in 2008 they were quite liberal in their lending. They were giving out loans up to 90%. Some of them are actually even up to over 100%. And for that reason, you want to make use of a lender that's not going to give you that capital call. All right, so let me just. Then the final thing that is very important for me is usually the starting point of it all is how will you exit? Because we essentially like the asset, we want to keep it at least 5 years. If in some instances, what we've seen now with our medical one, it's getting to that mature level. It's almost 4 years old now. The investors are getting a great return, so we've actually been able to, with our conservative approach with the returns, I've actually seen that we've outperformed what we've budgeted, and given that the investors actually don't want to sell, so we take a view as to we want to keep the asset on 5 years, just for the fact that we want to give the investors some money back, so we consider there's a bit of a capital gains over this 5 years, because for instance, there's a value play, like for instance in this building, there's a 5% that we can lease up, and there's a small portion, another small portion of the building that we can possibly also lease up at a different rate as the market rentals increase for office space. It means that the value of the building is also growing at the same time. So that's what we say when we're talking about the capitalization rate of the investments, is that as the demand grows, the capitalization rate actually shrink, which means that effectively you're going to get more for your asset when you sell it at the end of the day. But that cap rate is actually inversing onto what your net operating income is. So if you can increase your net operating income during the course of the 5 years, you are actually growing your value. And that's what we want to offer the investor, is that capital preservation. Firstly, if you're an investor from South Africa, you've got some rand exposure that you want to take out to the US. And essentially what will happen is that you can park it into a building that's offering you above average returns and a capital growth. Now, some of us want to take out that, after 5 years, take out that capital growth, and this is where the exit comes in. So for me, the important thing is not just the strategy which we've outlined here, but the fact is that will we be able to sell that building in 5 years' time? Because I've been fortunate to look at a whole lot of investments which has got great yields during the course of the investment, but I know for a fact that it's going to be a hard sell to get out of that market. So that is very important for me, to ensure that you as an investor will, by 5 years at least, will be able to get out. So what do we consider then? During that holding period, the investment committee, which is an independent investment committee, so they're not driven by Wealth Migrate that needs to make money to pay the water and lights and their staff. They are independent committee that's got a criteria that we use against, and they also evaluate this market conditions on a regular basis to consider the best opportunity. Because what could happen is that in 5 years' time, maybe the market is not as favorable as what we would have anticipated, and then there could be a reason for us to either keep it. It may be the case that if we've added value to a building, not really in this particular building, but maybe in another building, or maybe it could happen that we find that manor grows so substantially that we want to increase the size of the building, which means we added value to the building, and at that time it seems quite fitting to sell the building. Then we at the investment committee level will then just decide on that. So yeah, so essentially the strategy is to keep this building for 5 years, and hopefully if all stays into check, that we can give the investor a good return. I've already touched on our partner, which is also quite important for us. We've built a relationship now with Rick for the past 2-3 years, and we are quite excited in partnering up with him with his project now, which is Shadow Glen Medical 8. And the main reason for it is that he's a niche player. He is able to assist us in sponsoring the debt, and he's got available pipeline deals. So there's, I think there's at least 2 buildings currently that's already been stabilized that we can look at as soon as we are ready, and he's ready to sell, and it makes sense for us to go that route. But he's also already working on new developments that will come into play in the next year or 2. Right, so there, like I said, I mean, the services that they offer is the development side of things, the leasing side, and property management and project management. So he's got a team that is quite well versed in building health facilities. They've also got a good following, you know, so if you consider Rise is part of their other buildings, FastMed is also part of their building, so they've got a following when they move into new spaces and new areas. They basically can offer it to their tenant crowd that we've already know is quite well established. All right, and that's the story from my side. Yes, JP, I don't know if there's any questions that we can answer for the guys on the call.
Yeah, firstly, thank you very much for your time again, Billy, tonight. It was really insightful, and I really always enjoy listening to you talking about what's happening on the ground that side. We did answer one question. Michael did ask, so is there a fixed strategy? Do we have to sell after 5 years? We did touch on that, but also just maybe give a little bit of clarity. Is there sometimes an opportunity to sell before the 5 years? I know we typically project around 5 years, and we don't try to project longer than that, because then it comes a little bit crystal ball glazing, and our assumptions are becoming a little bit vague. Are there possible incidents when we actually add enough value and then we can take it to the investor committee and also to the shareholders to say, listen, there's a good opportunity to take advantage, call it that year, first quarter in year 4. Is that a possibility in the medical side?
Yes, I think there's always that possibility. I mean, if like I just touched on, is that if you get a solicit buyer, you know, that they see that they are going to get a good value for this building, it's well located, then that is definitely something that will be considered. Like I said, we want and are looking at the best interest for the investor, and if it makes sense to do that, then we'll definitely look into that for sure.
I see John is saying here, actually, he says, anything more specifically on other value plays that we can have on this specific deal? I know it is leased up quite high. What do we foresee as possible other value add strategies, if at all possible, in this specific deal?
Yes, that's a good question, John. Like I said, my anticipation is that with the master lease that we've got on the contract, there's some wiggle room. At this stage, I'm pretty sure that there's definitely going to be a lot more growth that we've seen since I've been there in October, and with Michiel, he and Yaku, they went to Manor, I think it was in April, and they were just astonished to see the growth of Manor. And yeah, so what could definitely happen, and what we've seen in some of the other buildings previously, is that you get a tenant which his business is booming, and he wants to expand a tad, now that United Healthcare Group also has taken over one of the leases, there could be a possibility that they might be wanting to expand some of the spaces, and that in essence will allow us to add some value to the building. At this stage, it's hard to say. I would rather say that this building is more for preservative purposes. It's a good value for money. The yields are quite good, and it's a quite new building. So there's not a lot of value that we're gonna add here, but yeah, there is a possibility.
Yeah, that's also good. I think that's good, because I think that actually directly plays into what John asked, is how does this opportunity differ from Medical 7, apart from it being in a different, call it the hub of the Textile place?
Yeah, I think the main difference here is the fact that it's a completely owned building. Medical 7 is a condominium, which has been owned by 3 different owners, which we've taken over the 67% of the condominium. We've already started the negotiations with the second owner of the condominium, which will add a bit of value to the building because there's some vacant space in there, and we're getting it at a different price, which is currently a bit lower than what we've looked to pay. What we actually paid for Medical 7, the 67%. So that's going to be the main difference here, is that it's 2 different buildings, in the sense that the one has got some room to move in. Medical 7 is also 100% leased, the 67% of it, but the fact that we can actually purchase the other 23% or 33% in the next year should actually add additional value to it, and we should be seeing that you could have a bit of an additional value play there. But I don't want to be, I like to be conservative, and I don't want to promise you that it's going to be shooting the lights out kind of different, but that's the main difference. It's also a quite older building, and that's also what makes it different, is the fact that it's a bit older. This one is quite new. It's 2 years old, and it's already stabilized, and there's not a lot of value play here at the moment, but I see a bit more value play in Medical 7.
Sure, let's just see if there's any other questions popping through. Are the dividends going to be paid out similar to the previous medical deals every quarter and typically 30 days after, or is it different, similar to what PPA does, 45 days and a little bit longer? How's this going to work with the new partner comparing to current investments?
Yeah, I think at this stage, what's the main difference, just to note on that point, is that yes, it's at this easier purposes, 30 days. That is what we will try to have it closer by. Unfortunately, with the PPA group, they are quite stricter, and we are working hard to getting them also to the 30 days. It's been hard going because they've got a lot of other investors in their pocket as well, which has come accustomed to the 45 days. You know, I don't know, maybe they've got too much money. They can wait 15 days longer. I don't know why. We are trying really hard to get them also down to 30 days. It is a bit of a hard slog, but yes, we have negotiated with Austin Street Capital that that's what we what our investors are accustomed to, so we will be paying out 30 days. And what I've been, as I've been working with Rick now for the last couple of months, the guy is quite precise, and he sticks to his guns and his word. And I'm quite confident that it should be 30 days after we did declare after we've closed the quarter.
Great. Another question here coming from Pierre is, what happens to your investment money if the project takes 6 months to become funded?
That's a good question. Well, we are in talks to expedite the process, like what we did with Medical 7, where we've pre-funded it. We don't anticipate it to take 4 months as well. What you probably would have noted and might be referring to is, for instance, Cypress Ridge, which has been on the portal for about 6 months, which can be indicative that it has taken 6 months to close the transaction, but we've actually closed it on the 7th of October, which meant is that we pre-funded it, and you were, if you were one of the first investors, you would have received your dividend in the first quarter of 2017. So we've only got 4 months to raise this, so it's not going to be 6 months. So we need to, as they say, by hook or by crook, close it before 4 months. We are anticipating that we should be able to pre-fund this transaction before the 4 months, if possible. And we are working on a project or a proposal that we might be able to see if we cannot pre-fund transactions before you have to wait that long. So we are working on it, Pierre, but your money is in a escrow account, so it's not in our account. We're not using your money. Just to clarify that, maybe I should have started with that. It's not in our account. It is it's in a safe account that is parked there. Unfortunately, it's not any interest, which is probably not what you why you're asking it. But yes, we're not going to take 6 months. We have got a hard close in 4 months' time. When we launch it, I'll confirm the closing date exactly. That's why I've not included it there. But when we launch it, it's 4 months.
Yeah, thank you very much, Willie. I think that pretty much wraps it up. Yeah, Pierre says, great, thanks. It's just a curious question. Still happy with the Cyprus Ridge. It seems like that should be all the questions. I don't know if there's any other burning questions from people online at the moment, but I think we'll be starting to log off. I think after tonight, what is the next steps? If you are interested in gaining access to the healthcare real estate market, you can go onto the website, you can sign yourself up. It's really easy. You just load a couple of documents to prove you are who you are so that we can know your client, you as a client. You can scroll and browse through the opportunities available, and you can select the investment which you are interested in pursuing, and you can do the transaction online. Alternatively, you did see the contact details there of myself, JP, and also my colleague, Jock, who are able to assist you. You can always give us a shout. And always please, there we've got an intercom facility on the website itself where you can actually ask as many questions as you can, and we will try to respond to them as soon as possible or reach out to you telephonically. So, Billy, from our side, I would just like to thank you for your time tonight. It was really great to have you share some of your insights again. And we look forward to, please do attend the events that we are starting to host from tomorrow. Billy will be sharing a lot more detail on specifically our due diligence systems and what we look at when we do evaluate any of the deals going forward. So I think that's definitely a not to be missed, and you can also go onto and register for those events at events.wealthmigrate.com, and we look forward to seeing you there. But anything from your side before we knock off?
Yes, no, I think thanks, JP. It's always great. I'm really hoping to see you guys at the events. Bring those questions. I'm happy to ask them, even if they are difficult ones. Yeah, hope to be able to share some new coming soon deals. And yeah, thanks again for joining.
Thank you, guys. Have a great evening.